welcome back. We're going to spice things up in this module, and we're going to be taking all of the information that you've learned about the corrections, and we're going to start overlaying the corrections on top of each other, looking at their similarities and looking at their differences as well. And then we're going to take that to the charts. I'm going to show you an exercise that you can use moving forward from here that is extremely helpful as well in order to increase your experience with this and get a lot better at it. So let's dive in. All right. So we've been learning a lot of information. I hope you've been studying up with the PDFs and the cheat sheets that you have in order to memorize all the characteristics about these corrections, because this is where it all comes into play right here. So first, we're going to start off with the ABCs, the zigzag, and we're going to overlay those on top of each other. We're going to look at the similarities and the differences of them. Okay, so typical zigzag 535 structure here. And we can also overlay a flat correction, which retraces about 80 to 90%, does about a 1-to-1 extension for the C wave there. What I'm going to do is we're going to change up these colors, and I want you to do the same exact exercise when you're practicing with the actual charts. I'm going to show you a little tip on how you can do that as well. So change the colors up so it's easier on the eyes here. So we've got a flat correction, a regular. Let's take a look at maybe an expanded flat. Notice that I'm keeping all of them at the same length of where I'm starting the 0 and the A wave. So the B wave here gets expanded. Let's do this one as a running flat. We'll take these measurements here in a minute and then readjust them just so that they're textbook perfect, easy on the eyes. Let's change up the color on that one as well here. And let's do an expanded flat this time. We're going to come down this way here. All right, so we've got our regular flat, running flat, expanded flat, and our zigzag. Okay, so this is a method that I call the boxing method with correction overlaying. And basically, when you're dealing with corrections, they're counter trend. So they're the riskier trades to be taking. You technically want to stay out of trading the corrections, and you want to get in at the point that is going back to the trend. So in this example here, price is going to be moving up because our A wave is facing down. A wave is always facing counter trend here. So we've got this price movement here. We'll make it green. And let's do another one off of this way too. Okay, so when we're looking at this here, we want to stay out of this territory here. Okay, so the center of the territory, this is where when we get complex corrections adding together, it gets really choppy. You get stuck in the middle. Your stops are too tight. You get wicked out. There's a lot of bad stuff that happens in this territory when you take a position here because you're putting your stop losses right below previous lows, right above previous highs, and so forth. So by overlaying the potential corrections that could play out, it helps you visualize where could price move and where could price pivot. Okay, so let's readjust real quick and make sure that our pivots are in the right spot in regards to like the fib retracement here. We want to check and make sure that our B wave is at the 1.236 to 1.382 pocket. So that looks really good. We want to make sure that our extensions here, we want to use the trend to base extension tool from 0, A, and B. We want to make sure that this C wave is either at a 1-to-1, 0.618. Okay, so we're going to go with the 1-to-1 there. Let's change up the color of it too, since we got two purple ones there. Let's do a blue. Okay, so, and then we'll check the same with this one down here. We've got a 1.618, beautiful. And then let's also check the zigzag here. And we've got a 1-to-1 on the zigzag. That would be fine. We could do a 1.236. What you're recognizing here is really the fact that you're below the blue box. So with the 1-to-1, the 1.236. And then the same goes for the flat as well. Okay, so the yellow count here, the flat, we've got a 1-to-1 down here. We've also got the 1.236. Okay, so we'll just go with the 1-to-1 here. And what I want to highlight here is that anytime that I'm looking to take a counter trend trade, I'm looking for the extreme scenario. So I'm looking for the expanded B waves up here because I know that my risk to reward ratio is going to be so much better than if I get in down here at, say, this red B, so forth. Because, and I'll help eliminate some of this here, but say we start off our three-wave structure, we know that we're dealing with a flat. Okay, so we know that one, we can eliminate the zigzag right off the bat. Okay, we also know that with a flat correction that the B waves typically have a deep retracement. Well, I don't necessarily want to, if I'm looking to short this trade here and short a C wave, I'm not necessarily looking to get in right down here, okay? Because I would have to put my stop loss for invalidation purposes, we'd have to put it above the expanded B pocket, and then my risk to reward ratio isn't very good. Okay, so because when I'm trading counter trend, I'm looking for the extreme entry and then I'm looking for a conservative exit. And I'm looking for a conservative exit because notice that I have a much more likely opportunity to get out at the yellow, the blue, or even the red C waves rather than the purple one here. Okay, so if I know that 2 out of my 3 flat corrections are expanded B waves, one, I have 2 out of 3 chance to get an entry in up here for an expanded B wave. And the exit on it, I know that the worst case scenario is going to be a 0.618, which was up here, and then the 1-to-1 here, and then we get into the expanded flats versus the running flats. So I'm going to take profits off the table, so to speak, at the 0.618 or the 1-to-1 for a running flat so that I don't miss out on this moving upwards at the 1-to-1 of a running flat instead of an expanded flat. And that's because I'm trading counter trend. Okay. Now I use the same method, but for getting into the entry to get back into the trend. I don't want to get stuck right here in the middle of all this shop because this is just a simple correction here and it can get dragged out into a complex one. So I'm looking for the extreme side of things. I'm looking down here towards the 1.618, the 1.382 kind of pocket instead, down here, so to speak, off of the pivots of any one of these moves here. So whether it's a zigzag structure or it's a 3-wave structure that we're starting off with, I can pull the pivots 0, A, and B, and then I'm looking for the 1.382 to the 1.618, the extreme side of things, because I know that the most popular corrective fib measurement is the 1.236 to 1.382 and down to the 1.618. So by making my box this entry here, or even just the 1.236 to 1.382, and then putting, any sort of a stop loss underneath the 1.618 in confluence with other indicators, it really tightens up my risk to reward ratio so that I'm taking the proper trades and managing my risk. Take a look as we look at the risk to reward ratio. If we were to enter in at the B wave here, we would put a stop loss above the 0.618 up here. Okay. And then I'd be looking for an exit, say down here at the 1-to-1 or the 1.236, okay, because those are our most famous corrective measurements, the 1-to-1s and so forth. So this almost gets you about a 2-to-1 risk to reward ratio now. So as long as it's meeting your risk to reward, requirements and the guidelines that you set up for yourself, which you definitely should have those guidelines set up for yourself, then you know whether or not you're taking a smart trade. So for me in this case, I could even tighten it up once we pivot, so to speak, and say we hit the 1.382 and then we pivot, I can then move my stop loss down and tighten it up to the 1.382 extension. What I don't want to do is take a move like here or here on the yellow and then put my stop loss right above the previous high, because what happens is the expanded B waves are pretty common and will go up and we'll tag that stop loss, and then price will move back down in the direction that you wanted it to. And I've seen this happen so many times. Happened to me when I first started, and I see it happen to people countless times hereafter, and it still happens. So, and it's because of these expanded Bs from an Elliott wave perspective that is really liquidating the people that are putting their stop losses right above previous high. So in order to avoid that, I guarantee this will save a lot of money, is if you just if you watch out for this 1.236 to 1.382 to pocket and put your stop loss right above it. Real quick, I want to just take you through some examples here, given this downtrend cycle that we've seen from Bitcoin. I'm going to move up to a 4-hour here. And we're going to talk just about that 1.382 to 1.236 pocket, okay, and what that actually looks like here, okay? So, for example, this low here to here, we are looking for the 1.236 to 1.382 pocket. Doesn't hit it there, okay, so probably wouldn't have taken a trade on it potentially. Let's try this one right here instead. Okay, and this, in regards to this one here, we would have looked for an entry at the 1236, 1382, would have been able to pick it up, stop loss under the 1.618. Okay. Again, let's just check another one here. You're going to see these all over the place. So absolutely all over the place, especially on smaller time frames, so to speak, too. This one here, if we were dropping underneath it, given this is a 5-wave structure, this would have to be a expanded flat. So we'd pull from here to here instead of here to here. We're going to talk about that more as we kind of get into this here. But remember, always pulling from 0 to C, 0 to C, connecting from 0 to C, pulling our fibs from 0 to C. Okay, so in regards to this one here, again, 1.236, 1.382 pocket, we would have snagged the 1.236, stop loss underneath the 1.618. We would have been able to catch this trade here. Okay, and then again, we just use the extensions to target out our trades, and we'll go through plenty of examples of that. We'll have another video right after this one too. This is just going to be focused on corrections and overlaying them so that because corrections are the hardest to actually master. And so by being able to use this this strategy in regards to correction overlaying, it'll bring a lot of clarity to corrections and help you out with the potential outcomes of it and allow you to be a lot more patient too. Okay, so I don't. That's good enough examples for me. Maybe we can check this one here too potentially. Let's just see. Sure enough, 1.236, 1.382 right there. Okay, so like I said, you're going to find them all over the place, especially on the smaller time frames with the smaller trades that you're taking. But anytime most people are putting their stop losses right underneath previous low, think about these people right here, right? That's a very good support line right there. So when it's broken, obviously this triggered everybody's stop losses because they're putting it right underneath previous low. But knowing what we just talked about in regards to expanded flats and the B waves, the 1.236 to 1.382 pocket is where you technically want to put your stop loss underneath. And then you're looking, this is all of that. That's that blue box. This is that blue box in regards to the larger move here. That's the blue box that you want to stay out of. Right there. All of that sideways movement right there. You want to stay out of that. You want to be on the deep end of the expanded Bs, or you want to be on the deep end of the 1.618, ABCs. And an example of let's take this move here and see if that one matches up at all. So that falls into our 1.236 to 1.382 pocket right there at the wick. I mean, it really is a beautiful pocket when it comes to corrections overall. Maybe, you can adapt your strategy accordingly to maybe you want to aim for the 1.236 to 1.382 pocket more than the 1.618, or maybe you want to be more conservative and aim for the 1.618. It doesn't happen as often, but when it does, you typically get a faster rejection from it. So, those are things that you want to kind of adapt to your trading style, knowing the information that you know after going through all of these modules, and especially after this one too, seeing these live examples. All right. Let's come back down here and just do a quick recap in regards to what we basically talking about here. So one, we've gone over basically how to trade the entries and the exits of corrections. They are conservative counter trend trades, so they are riskier. So I'm looking for entries on the more greedy side of things. The more extreme side would be the right wording for it. So the extreme expanded Bs, or I'm looking for the 1.236 to 1.382 to 1.618 pocket down here for the C waves. And these would be great for getting back into the trend. So looking for the buys down here in regards to these corrections, not necessarily getting in and staying out of the blue box right here. Okay, so now we also get the process of elimination here too, which you got a little bit of an insight on that. I'm going to clear some of this up here. You got a little bit of an insight with that, with the way that the first correction comes down. If we come down with 5 waves, we know we're dealing with either an impulse wave or a zigzag. Either the trend is reversing, okay, and we're going to come down with a bigger impulse, or we're just doing a small impulse wave and then we're correcting back up, and then we're getting a zigzag instead. Okay, so with that being the case, we can eliminate all of the different flat scenarios because the only correction that starts with 5 waves is a zigzag. Okay, same thing with the zigzag. If we get a 3-wave correction down, that obviously looks very clear 3 waves, then you can eliminate the red count. Okay, and it leaves you with these 3 open opportunities. What if you start with a 3-wave, then that the B wave typically retraces deep. And if it doesn't, then you're just not taking a trade on it. At least that's how I'd play it out. So with that being the case, if it does come up this high, I know that I have a really good risk to reward ratio by entering in at the 1.236 to 1.382, stop loss above the 1.618. Once it pivots, I move my stop loss down to the 1.382 above that previous high now, and then I look for that impulse wave down. Now the C wave we know always has 5 waves. So again, if all of a sudden we come down like this and we pivot and then we come down and then we start to move back up, from an Elliott wave standpoint, you know that you're invalidating any sort of an impulse wave right here. You know you're dealing with a 3-wave correction now. Okay, and so when that happens, you know that you're not dealing with a C wave anymore. It's a 3-wave. So now you know you have a complex structure on your hand. Either that complex structure is either completing itself or it's not. Here's a couple of ways that we know. One, if your B wave was expanded and then you come down with a 3-wave correction, then you're dealing with a complex structure and it's not done. Why would it not be done? Because the X wave can't surpass the start of your W. So if I start off with a 3-wave here, and then I start off with another 3-wave back up here, and then another 3-wave down, it tells me this cannot be an X up here. So we have to be dealing with some sort of a correction that is just starting or halfway done, but it's not completed. Okay, so either we need to see continuation like where I'd go like this, and maybe this whole move here instead is some sort of a larger correction of a larger degree. Okay, but by knowing these little tips, you're able to eliminate that. So when knowing that the X wave can't come above the start of W, you say, okay, well, what would I be dealing with here instead? Maybe you're dealing with a larger B wave. Maybe you're going to get an impulse back up right here, and now you've got a, let me change the color here. Now you've got an A, B, C here, which all becomes a B wave. And this is your A wave down. And so you're going to now impulse back down. Okay. All you did was make a expanded flat correction. The B wave was just bigger. It was just more drawn out. Okay. And you'll see this happens quite often, as B waves are the most prevalent for being typically flat corrections or just being longer. They take longer. They have less of a degree of a angle than the A wave does. So they trail more sideways, or they're not very vertical. Okay. These are all the things that you're going to take into consideration. And all of those PDF sheets have all of these characteristics and guidelines on them. So if you're not sure, if you can't remember it all, is that you don't need to go back and rewatch the videos. You just study up that PDF. The video is to give you a good visual, so you have a good visual understanding. But once you've gone through the videos, it's worth just going into the application videos furthermore and actually seeing how it's applied to the charts here. So this is correction overlaying, all right? And this is just with the ABCs. All right, I want to real quick also take a look at how it correlates into, say, triangles, because we talked about how triangles are commonly seen in the charts. However, they're not actually triangles. So what are they? What could they be? Let's take a look at this. What works in nothing but 333, right? And is similar to the ABC of a triangle. A WXY does. Okay, so we could have, we could have a WXY like this, and the Y wave is just truncated with a 0.618 extension. So take the extension of it like this, and notice that 0.618, bring it right about there, tighten up and draw this trend line this way. Okay, and there's the start of our triangle. You can already start to see price contracting. So then what happens then? Well, we can't have a complex structure inside of an A wave, so we're not going to get some sort of an ABC. We're not going to get a WXY here. So how can we have where would we see continuation of this? Well, a lot of the times, and you're going to see what happens next, is actually going to be where we get an impulse move. But the wave 1 goes back up to where that trend line resistance is at. We pull back for wave 2, and then we push through for 3, 4, and 5. Well, this can happen the exact same opposite way too. Okay, and so as long as if you're not paying attention to what the subwave counts are inside of your triangle, then you're going to mistake this a lot of the times, and you're going to see a lot of triangles. But from an Elliott wave perspective, if you're paying attention, you know that wave 1 has 5 waves in it. So inside of this triangle, you're going to see a 5-wave structure And that is going to tell you the continuation. Or you're going to see it, let's take a look at maybe from an ABC standpoint. And you can see these in, in a bearish trend or in a bullish trend. It doesn't matter. It's just going to be turned around opposite direction there. But let's just go with a ABC. So a B, and a C. Again, price is contracting here, and then you've got your wave one. Okay. Well, we also know too that an A wave can start with an ABC in it. So this could also turn into a complex structure by going into an A, and then we break up for a B, and we only go like halfway, and then we come back down for a C. Let's change the color of that, because think of how that right there can wreck somebody. Because if you look at the ABC and then the impulse wave, awesome. You see a triangle, triangles are continuation patterns. So you jump in, you go long, you look for the impulse wave. You look on the breakout there. Well, two things that the mistakes are made here is, one, if you play this breakout right here for the impulse wave, more than likely from an Elliott wave perspective, you're going to be, if you're not counting and know what's going on inside of this triangle and you just think it's a triangle, you're going to pull your extensions wrong, because in order to pull your extensions, you actually need to pull them from inside of your triangle. So if you're not counting your waves in there, you're going to make the mistake of actually pulling your extension from the first wave on the breakout. And you're going to think that is your wave one when it's not. And so you're going to be aiming for a much higher target than when it pulls back. And it's going to pull back early on you. So that's number one mistake on how somebody could get, endure a loss by misreading that right there, even though it's breaking out in the right direction. The other here is that with the ABC, notice that the break up immediately turns to the downside. So if you're seeing this continuation pattern, you want to break to the upside, then obviously you're going to fall really short of your targets there. How can this happen? Well, again, we'd have an A, we'd have a B, and then we'd have a C. So with this being the case here, notice that we have 3 waves in A, 3 waves in B, 5 waves in C, 3 waves in A, 3 waves in B. Okay, so there's only one wave in this entire triangle pattern right here that is telling you it's not a triangle. And then you can also pair it up with RSI as well, right? So you know that RSI should print that same pattern. So if there's any sort of hidden bullish divergence, any just regular bullish divergence, any sort of divergence at all, that is also going to help you, indicate that you're not dealing with a triangle. So it's very easy to get these mixed up if you're not paying attention to your subwaves, and you'll recognize this amongst a lot of Elliott wave analysts out there, that they're doing a lot of stuff by eyesight, especially when they're just first starting out and learning. They're just pulling it by eyesight. They're not checking their subwaves. And the reason being is because it takes time. It takes time to dive in and make sure that you've got 5 waves in this one here. But if you do it the right way, you become much more profitable with it. So I want to put that out there. I want to show you how these corrections are mistaken for each other, and that it's really the subwaves that you need to pay attention to. Okay, so the giveaway here is not the C in the red here that's moving upwards. It's the C in the blue. This is the one that's giving you notice ahead of time, so that when you see 3 up and then 3 back down, and then you see this break to the upside, you know this is going to be a false breakout. Okay, and then you can use the proper extensions for that A wave from 0, A, and B, and you can be looking for that 1.618 extension. You can also, too, you know that you're going to be dealing with a larger correction here. Notice the red ABC. So I'm going to change the color on this one here. Notice the red ABC, all right? That is only part of these 2 blue corrections here. ABC in blue, ABC in blue, and then we get a 5-wave impulse down for C. Okay, now that is all together in the red an ABC correction. Okay, and then if it wants to become complex, that ABC would turn into a W, or it would turn into a larger degree ABC. So you have to make sure that you're using time frames with your corrections as well, and you got to get familiar with knowing what time frames to trade in. So my best tip in regards to time frames and corrections is to use the same time frames when you're charting. and get in the habit of using the same sequence. So for me personally, I always go from monthly, weekly, daily, 4 hour, and 15 minute. The reason for that is because I've built a good relationship with knowing what the wave formations on a 15-minute time frame look like when they build into a 4 hour, so that I can take larger swing moves on the 4 hour and I can take scalp trades on the 15 minute. And I can also zone in and target a really good entry and a really good exit for my 4 hour swings by using the 15-minute time frame. So whichever you choose, whether you want to throw the 1 hour in there or whether you want to use 6 different time frames, I recommend using time frames that break up in the same amount. So in other words, if you go from a 4 hour to a 1 hour, you know that there's 4 1 hour candles in a 4 hour candle. So it makes it easier on the brain to process it, to picture it, what needs to happen in these 4 hours to affect my 4 hour candle, so forth. And that's something that we talked about in the time frame and in corrections here as well. And I'm going to show you that as we dive into the charts as well. So I'm going to end this module with the correction overlaying that we've done here. And the next module, we're actually going to just dive right into the charts and put the application to it. So I want this to kind of sink in a little bit. I want you to think a little bit about how they can overlay differently too. Which ones may I have not gone over that could also offer similarities. And we'll address them more in the next module. It's just going to break it up, make it a little bit easier on you guys to absorb all that information. The one trick that I did want to tell you in regards to going back and practicing this is to use the replay button on TradingView and go back, and you can just cut off the time here. And by doing that, and we're going to do this in the next module too. So by doing that, when you get here, you can't see any of the price, but you can play it forward. And so what I want you to do is I want you to actually look at the current price and make a count on it. Okay, so I've got 3 waves here, and then it comes down, and I've got 5 waves here. Okay, so I've got a 335. Okay, so if I've got a 335 there, then either we are continuing an impulse wave down, and you can pull your extensions, make it look all beautiful. Take your time to do it right. Okay, so that's one scenario here. We've got an ABC, and we're going to do an impulse down. Look back here at your previous, where your trend is at. Obviously, the impulses are down, trend is down, corrections are sideways. Okay, what else could happen here? Well, if we have a 335, I know that could be a wave of a larger degree, so we could correct more. What I know for certain, though, is that with a 335, I cannot have any sort of a reversal right here because we bounced off of it correctively. We can't continue a trend without having that impulse to kick it off. So because of this 3 waves here, I already have confirmation and validation that this is going to be corrective. The only question is next is this going to turn into a complex structure? Is this a W wave of a larger degree where we come back and we correct maybe 50% and do another Y wave there? Is it how about an A, and then we come down, maybe we do an expanded flat and we got a running flat. We could do an expanded flat, and we'll change up the colors on all these too. So expanded flat would bring us back over the top of the A wave. So let's change that to purple. So see how I'm overlaying all these corrections again? This is powerful, guys. This is so powerful if you just practice it and get good at it. So let's say we could also do just a regular flat. So price doesn't have to go below this previous low again. So I'm going to put a little horizontal line there as well. And know like, hey, this is our first A wave completed. And then let's take a regular flat. And we'll just do a 1-to-1. So kind of a double bottom there. And let's change that up to yellow. Okay, so we've got an option for an impulse wave down. We've got several flat correction options here as well. And we've got a WXY correction. Okay, so now I want to overlay my box on this. And we want to stay right out of this territory here, basically. Okay, so we're looking for anything up here. We're either looking to short to get back into the trend because the trend is down. Anything down here, we're looking to buy to come back up and play counter trend. Because it's counter trend, it's a riskier trade. So we take smaller position size, manage our risk, and we look for the conservative exits. So we're not looking for up here for the exit. We're looking for the top of the box here for our exits, particularly the first one being the running flat, because that's our worst case scenario is the running flat. It gives us the least amount of profits. And then our next one is just the regular flat, where we're looking for just a 1-to-1. So 0.618, 1-to-1 is where we're looking at here. And then what you do is you go back and you just hit the play button. And you wait here and you kind of just let it play out here. And when it does something that you don't like or that doesn't match up with where you're currently at, you pause it, you dive into it, and you look at it, okay? This is going to help you learn the process so much better here. And you can speed up the, how fast it plays out here. You can slow it down if you really want to observe each candle, get better with price action study, etc. Okay, so notice here we've come down. We've hit right about the 80%, 90% pocket right here. So we know that this is right about flat territory for a regular flat. All right, then we get a good wick right there. We're going to kind of dive in, blow this up a little bit. All right, and of course you would I pulled all this from eyesight because I get pretty good at it with how long I've been doing it, but you would obviously pull your fibs and make sure that you have the B's at the right pockets, make sure that your C waves are at the right extensions, so forth, okay? So notice our yellow one here, and you're going to adapt your own strategy for this, just given what this is doing. But you either are looking for the double bottom entry, right, for just a regular flat, or the expanded. Maybe you take a smaller entry here because your stop loss is going to be further away in order to prevent you from the expanded flats. So you take a small position here, but at least gets you in the game if you don't get the expanded. Okay. And then as we're moving up here, again, here's our C wave. We're taking profits right there. So here, look at the wick there, right? So we're taking the first profits off there and we're like, ooh, okay, we've got 5 waves right here. That could have been a running flat right here. Okay. Sure enough, there we go. We get the dip down. So now we know, hey, okay, it looks like we're dealing with a running flat there, or a truncated, because the B wave didn't dump underneath our previous low here. Maybe we're dealing with a regular flat with a truncated 0.618 C wave, which comes right here. Okay, so you're just process of elimination is how you're basically looking at it. Okay. And so maybe you would have taken off partial your table of your trade there, given that you hit the 0.618. Maybe you would have been looking for a higher one up here at the 1-to-1 and not have gotten it. Okay. At that point, when you impulse back down, you know that it's very highly likely that the trend is continuing. So maybe you get out of your trade here in profit. Okay. And that's just a tool that you can basically use to analyze and say, okay, hey, look, what's going on here? And when I have all of these corrections overlaid, and which ones can I eliminate? So when we bounced here, maybe the flats came off the table. Okay, maybe we had a different count inside of here. In this case here, what ended up playing out, I'm going to pause this. What ended up playing out was your expanded B here. Okay, and inside this move here was a zigzag. So it was a 5, 3, 5 zigzag. I'm going to clear that off and you can see it here. So you had and this is good to pause it and be able to look into it too as well, but you had a 5 and then a 3 wave and then a 5 wave down. So you had a zigzag for your B wave. Larger degree like this. So A, B, C. And this hit your expanded B pocket. This was your 3 waves down as a zigzag. So, and this is a great example too, that your trend is down. Your trend is down. So you get a leading diagonal, you get an impulse wave. That's very, very good example of how the zigzag looks identical to a 1, 2, 3. The way that you're able to determine this is, one, where you stop off at, too, and start to pivot, and that expanded B pocket. So if you're looking at this and you said 5, 3, 5, you're like, okay, so it's either an impulse or it's a zigzag. Which one is it going to be? Well, you pull. If it's a zigzag, you know it's corrective. So it's either got to be a expanded B, which is going to fall in the 1.236 to 1.382 pocket, like it did perfectly, right? The other option is if it's impulsive too, you know that this move down should hit a 1.618 extension of this move right here. And we only hit a 1-to-1. Okay. So if you're looking at that, you know your first stop is the expanded B pocket first. So you can take the risk and trade the expanded B pocket with a stop loss underneath. Fib retracement here again. Stop loss underneath the 1.618 right here. So you put buy orders at the expanded B pocket area. You expect this to be a 1-to-1 extension for a zigzag. If it's not, it's going to be impulsive. If it's impulsive, it's coming all the way down to the 1.618. Okay, so this is how you basically go through that process of elimination, you guys. I hope you found this module beneficial. We're going to be diving into some more examples in the next one, so I will see you in there.